one of our goals with this Zoom meeting was really to kind of give you a look at what we look at. There's a lot of things out there are, emotionally driven. You watch the news and everything, the world's ending. Um, you know, we doing this for a long time, you learn to disconnect from that and try to look at data to make better decisions. Because, basically the goal at Rock Martin is really to be opportunistic. So over time, I've learned it's better to be opportunistic and be right over time versus be, right for a short period of time. So those are the things that we'll talk about, and I'll show you, some data, market charting, and I think with all the information that's going on out there right now, the things that we're concentrating on today was really more risk, inflation, and business cycles, how business cycles work with markets. So I'll just get started if everyone's ready.
I think we're good. Let's do it.
Perfect. Here we go. So the first slide I'll go over is just basically, this is something you need to realize that markets go up over time. Markets go up. There's a lot of things that happen in markets during, different time frames. So short time frames, markets fall. Over time, they go up. And what drives markets? Well, there's a few things. There's a lot of things that drive markets, but I think the most important things is, demographics, productivity, innovation, and in the world that we're in right now is liquidity and credit. So where in past history, it was more, making money, earning money, putting it to work. Now the world works where you can start up a business with very little money down because you can get credit. And that's what creates a lot of the issues that we have today. But, that's the world we live in. So we have to navigate that world versus being scared. So again, here, this is just a chart of when you're investing, this is what markets do over time. They go up. And then also here, you can see these downturns and movements up. So V-shaped recoveries, usually there's V-shaped recoveries in markets. And also, the first part of the recovery is really the one that's the most aggressive, which we'll discuss later on. But this is where markets fall, people are fearful, it zooms up, recovers 50% of its downturn, and people are still on the sidelines. They won't get in until later on. So taking advantage of this point is very important. But I'll move on to the next slide. So here's an example of in the past chart, you saw basically markets going up over time, and this kind of breaks it down into periods. So really, if you're a betting person, would you rather bet on the bull or the bear? And again, that's kind of what I meant, where we try to be right over time versus be right during a short period of time. Because when you have a bull market, on average, a bull market lasts 4.4 years. With the cumulative return of about 155%, and a bear market lasts about 11 months with a downturn about 32%. So, markets move up, then they fall a little bit. This is part of what the markets do. And also, what I wanted to bring up here, if you see these gray sticks, what that is basically recessions. So we're going, say, for example, everyone thinks we're going into a recession. Well, should you sell? Well, history shows us that markets don't go down during every recession. There's times like right here, recession, but markets went up. So timing that really isn't so crucial. It's really kind of knowing when that peak is, when the turn in the business cycle happens, when rates, Fed pivots, maybe rates start falling, earnings start coming back, because who determines anyways what a recession is? And it's really the Bureau of Economic Research, National Bureau of Economic Research comes out with that data. And what they'll say is basically, great, the recession that we're in right now started 8 months ago. So it's not anything that's put together in today's time. I mean, there's times I think that they named a recession that started a year ago. So they really need to have all the data they need to make that decision. So going into recession, you may hear, a lot of fear mongering out there that you should sell. But as you can see here, since 1942, every stick, some of them market was down during recession, but most of the time, that's kind of when things are already starting to stabilize. And when we come out of the recession, markets are usually, so if you do what the market performed from the beginning of the recession to the end of the recession, I mean, usually it's like, it was down 1%. It was down a lot during the downturn, but then it recovers. So bulls over time, that's what you're focused on because that's where the money is made. This is another way of looking at it as well. And here, again, it's the same thing. So I'm really trying to knock that markets go up over time. Very important. But what happens is there's cycles in markets. So here you see, this is since, since 2000. So you see this sideways, then uptrend, sideways, uptrend, sideways, up.
Yeah.
So
this one goes to 1900.
Oh, I'm sorry, 1900. Okay. I was going to say that's okay. So 1900. So a lot of data here. Yeah, the 1972, 1973 oil embargo. So this is the time frame that people are kind of saying that we're in. 1972 around here, like a lot of inflation was going on and energy prices were up. But really, what I want you to take out from this chart is there's bulls, there's cycles. So you have these secular trends. So like a bear can last, a bear market could last, like we said, about 11 months, but a bear secular trend, could be 10 years, just as a bull market. Usually what you have is you have secular bull markets like this, and like right here, that they last 10 to 30 years. So since the beginning of this chart, you have 10, 15 years sideways, 20 to 30 years up, 10 sideways, 20 or so up. Here you have again 10 or 15, and we're about 10 years or so, 14 years into this secular bull. So I think we are still in a secular bull market, but within this secular bull market, you still have downturns. You still have stocks going down 20, 30% in a given year. So, and that's always important to know is where are we? Are we in a sideways market or a bull? And I personally think that we're still in the secular bull market and will continue.
Mm-hmm.
The next thing that we can discuss is really, behavioral finance. So what is risk? So we discussed markets and how they perform. They go up over time. There's times of sideways and times of down markets. But, what really is risk? And that's a tricky question. You think it'd be a simple question, but it's not, because when you're investing, you can't look at a single time frame. You can't look at today. If you look at today, of course, it's, usually you fill out a questionnaire that says, if you're down 20, 30%, would you be scared? Of course, you would say yes. But what does that mean for your 20-year money, your 15-year money? So, risk, for example, if you feel risky today and you reduce your exposure to, say, the stock market and you put it in your bank account, you just reduced your risk today, but you increased your risk for your 10, 20-year money, So that's the thing that we really focus on, is educating everyone on really the true risk. And we really measure it by cash flow. So really knowing how much money you need. So if you need, $100,000 in 3 years, we try to keep that safe, but then your, 4-year money, 5, 6, 7, especially 10-year money, it should be in the market because you have 10 years for that to grow. So I think textbook, looking at risk from a textbook perspective, your age isn't the best way to do it. It should really be done by how much money you need. Because if you have $1 million that you're not going to need in 10 years, but if someone says, well, would you be scared if you lost 20% of it this year? You'd say yes, and you put in something safe, but you don't need it for 10 years or 15 years. It's really something that needs to be analyzed, is the time frame of your money, and you invest that accordingly. So risk, again, that's something that we try to help our clients understand in a different way. So when there's a downturn, they actually add to the downturn, versus when there's a downturn, they panic because they look at the whole account and they sell. And that has worked. I've been doing it since before the financial crisis in 2008, which I know there's some clients on this call, my first clients, we've experienced a lot of things, and that's what we've done. We've not blindly, but during difficult times, we reallocate and we buy things that are down, and we get rewarded, as you saw in that chart. Usually the first 7-8 months of that downturn are the sharpest that go up, and the goal is to recover as quickly as you can, so when the market is still trying to get back to even, you're already even, and then you're just making money. So the 60-40 is your conventional moderate portfolio, which means 60% stocks, 40% bonds. So that's your moderate. And I always say, well, what does that mean? I don't understand what that means, because most people say, yeah, I'm moderate because I'm not aggressive, I'm not conservative. But again, if you look at it from the cash flow perspective, it's completely doesn't make sense to look at it from that way. And even last year, a moderate portfolio, a portfolio 60-40, which you think would do well because 40% safe, was down around 16% while the market was down 18%. So because bonds, when interest rates go up, bond prices fall. So now you're 60-40 because of your age, and you're 40% in something that you know is going to fall, but you're still in it because that's the textbook way of risk. So again, we adjust that according to what the economy is doing. If we think an investment is not going to do well, we don't go into that investment because just because of textbook, it's safe. So again, risk tolerance and risk assets are change constantly, in my view. But here is, for example, this is 2 portfolios. So here you see a pie chart. So this represents your money. There's 2 of them. Say someone's invested more on a conservatively, so 28% in cash, 31% in US, 15% non-US, and then bonds. So 30, 40, 46% in the market. The rest is fairly safe. Okay. Conservative portfolio. And this one is, you can see the blue US is the stock market of US stock market 68. And then you have the US, non-US with 20, so 60, so 88% in the market here. And then here you have, 46% in the market here. Very different portfolio. So what are you doing really here? Well, really, you're just reducing your volatility with this portfolio. But by reducing your volatility, so you see, like, you can see my mouse, right?
Yeah. Best and worst time periods.
Yeah, so best and worst time periods. So this portfolio, the best 3 months it had, so this is since 2013, it was up 13.73%, and it was down 13.9, so down 14. This same portfolio, the best 3 months it had over that time frame was 32, but the worst 3 months were 23. So you see what you're doing here by reducing risk, you're reducing your volatility. And that's, again, one way to look at risk. Are you okay with your accounts moving up and down? If not, you become more conservative, you reduce your volatility, but you also reduce your long-term rate of return, right? So what about a year time frame? On a 1-year time frame, and this is really kind of what's interesting to me, is so the best 1-year performance over that time frame here was 34% to the upside, 12% to the downside. This best 1 year was 82 to the upside, and then 18.35 to the downside. So you see, as time goes on, you're giving up a lot. You're giving up about 50% to the upside, right? Because this is up 82%, and this is up 34. But on the downside, this portfolio is down 18. This one's down, 12. So, 7 or 6% to the downside.
Right.
This aggressive portfolio protected you, or no, this conservative portfolio only protected you 7% more to the downside, but it missed out 50 to the upside. And here is the time frame of money. So on a 3-year time frame, this conservative portfolio was up 12%, its best, while it was up. So its worst performance over a 3-year time frame during this time frame here was 1.2. While this more aggressive portfolio, a lot more, was up 26% and then was up 2.3% over 3 years. So
Hmm.
this is kind of where I go, you know, more aggressive investments are more conservative over time. It's kind of like a bank account. You're guaranteed not to lose money today in your bank account, and you can lose it in the market today. But 10 years from now, your bank account is actually more aggressive over a 10-year time frame because you're guaranteed to lose money to inflation, where the market, even if it's flat, dividends alone, you probably have a 60 or 50% rate of return on it. So, and that's why looking at risk from a different perspective, you don't want to look at it from, oh, I'm down today, because what does that really mean? It means nothing for your money that you do not need until you're 10. And if you reduce your risk, you're reducing your volatility, but you're also reducing your rate of return over time. Like this account here was up 12.55% per year, or per year. This account averaged 5.25. This account here started with 370,000, and what is like 9 years? It's up it's up to 1.16 million. This
Mhm.
account started with 345, and it's to $582,000. So again, from my experience, the people that don't pay too much attention to the volatility, too much attention to watching TV and what the market's doing, are the ones that do well because they avoid the risk of convincing themselves to be more conservative. Because markets, again, as you can see, even an aggressive portfolio is more conservative. It's more volatile, but you make more money over time, even though
Sure.
your 3-year time frame.
Yeah, it's like a real life example of stocks outperforming. It's
Yeah.
proof of that over the long run.
Yeah, absolutely. And it's, if you can look at back, I mean, geez, any time frame, even before the financial crisis, before quantitative easing, markets still perform about 7% per year after inflation. So the evidence is there that that stocks work over time. It's just, I think the accessibility to information that people have, the more they have, the more they scare themselves out of it.
Mhm.
So. And here it is. So this is another good example. This is basically shows you your it's a fear gauge basically, and it's run by the American Association of Individual Investors. It's a magazine that goes out to financial professionals, and it measures bullishness versus bearishness. So basically, how it works, on April 24th, 23, 24% of people were bullish, and there's like, I think, thousands of people that they send this out to. 38% were bearish. But what's interesting, so historically, this is how it looks like. Average 37% of people are usually bullish, 31 neutral, 31 bearish. But this caught my eye here was historical view, 1 year bearish high. So you have week ending October 21st, 2022. They ran this report again. 61% of people were bearish. And we put up a chart here of this is the stock market last year.
The S&P 500.
S&P 500. And right here, this is like where this is where it was, this survey was performed. So you see the market bottomed about a week or 2 weeks after this was, so you got always you fear when you're usually fearful, you're approaching some kind of a bottom. So buy when everyone, like Warren Buffett would say, buy when there's blood on the street, right?
Yeah.
And I always say, your intuition, your gut feeling, you use it in life because it's very useful, but not in investing, because whenever your gut tells you to sell, you need to buy, and whenever your gut tells you to buy, you need to sell. And that's from experience.
Right. It shows here.
Yeah. So, but this is the perfect example, behavioral finance, and that's again why we take this out and we try to, and we'll get into that a little bit more detail, what we're looking at. So now jumping a little bit more into the stock market, how it works and what we look at. So this is basically your S&P 500, and the S&P 500 is made out of sectors. You have information technology, healthcare, financial, consumer discretionary, industrials, communication services, consumer staples, energy, utilities, materials, real estate. So this is a composite for the S&P 500. And every single sector performs differently in different timeframes. So right now you can see that technology is 25% of the S&P 500. So if technology falls, like last year, technology was down, 30 some percent at a certain point, it pulls the market down substantially. If utilities are down 50%, the market might not even notice, So so you see which sectors are important to the market. So we need technology to do well for the market to do well. Healthcare is a pretty good weighting. Financials 13, it was a little bit higher, but as financials are getting a little beat down. So that's low now. And but again, this is what makes up the S&P 500. And what we do is we try to determine which sector is going to outperform. And that's the one we overweight. Like last year and the year before, we started buying energy. Energy was, I remember looking, it was 2% of the S&P 500. And historically, it was like at 6. So, I'm like, okay, we definitely need to get into energy. It's so cheap. And now it's at 4%. So last year it was up 60 some percent. And we were overweight that sector. And we'll get into that a little bit later, what we're overweight now. But, so again, this is what makes up the S&P 500. And we look at this allocation and try to modify it to put more money into things we think will move up. And this is so all those things I just talked about, this is the performances of them. So energy, last year was up. So last year, the S&P 500 was down 18%. Energy was up 65. Utilities were up 1.6, and technology was down 40. So you see, like, if you can pick the right sectors or overweight the right sectors, you can outperform the equity exposure of the portfolio. And then this is year to date. And what this also helps us do too is kind of determine where we are in a cycle, because different investments perform differently in the cycle. So here is basically a chart showing you this line here is basically the business cycle. And Fidelity puts this together. They also have a really nice chart which shows you where each country is. And I think US, they have like right around here. Mm-hmm. And China, they have it's coming out of a recession. So they're about like 12 months ahead of us or so. And but what's interesting too is that when you look at, and they put this together, they did extensive research since 1962. So this chart is based on the business cycle data from 1962 to 2016. And what they say is, okay, early stage of the business cycle, you want to own financials, real estate, double plus, consumer discretionary, technology. So it tells you what you want, what things outperform and which ones you should overweight in different cycles. But the hard thing is to know where we are in the cycle. And that's where we're leaning towards, that we are in the beginning stages of a new business cycle to the upside. So maybe like we're probably here, Mm-hmm. And what helps us make this decision is business cycles usually turn on an event, they pivot, maybe like when the Fed starts reducing rates, expansion, business expanding, because we had contraction for all this time. And also the market is a leading indicator. So the market will tell, well, not always. So you have to, again, you can't get, it's like if you run a chart, it's not going to be perfectly like this in the early stage, so it's always some things are working, some things are not working. But when you look at, this is where everyone thinks that we're going to, right? And just to kind of give you an idea, oh, here they are. So this is where everyone thinks that we're going to. But then what we did is we wanted to show you the performances of these sectors last year. So, and then performances of this year to date, the sectors year to date. Right. So if you look at during this time frame, financials, you don't want to be in real estate. Okay. Well, negative financials, negative real estate. What did real estate do last year? Real estate down 26. Financials
blue, yeah,
down 10. Consumer discretion 1+. So you kind of want to be in consumer discretion. Consumer discretion, again, see, down 37, so it's not always 100% correct. But industrials, negative.
Mhm.
Industrials, you have down 5%. Technology, negative. Technology was double negative, right? So down 40% and 28. All right, consumer staples, positive. What do consumer staples do? Oh, consumer staple, flat. Healthcare, double positive. What did healthcare do?
Pretty flat, down 2.
Oh, flat. Again, when the market's down almost 20, right?
Mhm.
Energy flat, they have. Energy was up 65%. Consumer cyclicals, negative, pretty flat. Oh no, staples. This is consumer staples. Consumer discretionary, consumer service. Yeah, this is what this is. And then utilities, double positive, and utilities were positive, right? So everyone thinks we're going into this part, but based on where the market is, it looks like we were there. And then what performs best in the beginning of the cycle? Financials up. Well, what are financials? They're down 5 again. We're having little bank issues now, so that's that explains that. Real estate, a double positive. Real estate
Up 2.
up 2.
Yeah, the pink one.
Oh, pink. Real estate up 2. Consumer discretionary, double positive, up 16. Technology positive. 21 and 20, technology. Industrials, double positive, up 3. Materials, positive, up 4. Healthcare negative, energy negative, utilities. So where's healthcare negative, energy negative, utilities negative, right? So if you look at that, again, we're in the business of trying to find the turning point in the market. And if everyone thinks we're going into recession, the market's falling, why are all these early rebound investments performing the way they should be during the cycle of now Fed maybe pausing and reducing rates, liquidity going back into the market, which will push these investments up? So again, it doesn't mean that it happens, but this is the stuff that we look at to give us conviction. All right, do we sell now, or do we maybe buy these investments, especially on dips? So this is a business cycle. And then we talked about secular trends, but there's also these seasonal trends or monthly trends. Like April usually is a good month. So we were expecting a good month last April, and it was flat, down, well, up a little bit, I think, depending on what you own. But May is usually a bad month. I don't know if you guys know the term sell in May and go away. So there's a good probability of the markets being down in May. But what does that mean? Well, if it's down and we believe that the trend is up, they're just good entry points. When we're in a downtrend, you try to maybe stay away, but again, so next few months we could have a little bit of turmoil because liquidity is being drained out of the system, and liquidity drives the market. But again, cyclically, it looks like markets could move up a little bit into mid-May, pull back, but again, I think the May being one of the worst months of the year, and June, July, I think will be interesting because there's a lot of stuff going on with the banking system. But this is telling us, and inflation's telling us, that we're starting to be in a beginning business cycle, but doesn't mean it goes straight up, right? It could still fall 5-10%, then you go up, so it's a couple steps up, one step down. So but again, this gives us indication of performance, that we're bullish than ever.
Right. And Marty, one thing you said before we got on here that I think is important to bring up is that, like, that slide we just looked at, for example, is just one piece that you're looking at when making investment decisions, right? It's one piece of the puzzle that you're putting together. Then you factor in other elements that could impact your investment, but this is just one part that you're looking at.
Oh, absolutely. Yes. This is one part. I mean, there's, 30 different parts. And again, what the market is this continuous changing, I don't want to say game, but it's this continuously changing, thing that you constantly have to educate yourself, change the things you look at. It's not always the same. It's all, it always changes. Or during COVID, we looked at, some countries were exposed to COVID a little bit quicker, and we looked at their markets, how they performed, because they started that, cycle a little bit quicker. So it always changes, and that's the fun part of it. I think if you like, puzzles and trying to anticipate something. So when things are already doing well, when say like, so you wouldn't really look at earnings, because if you look at earnings, and yes, earnings are great, better now, that means you've already missed out. So the challenge is to kind of try to anticipate when the change is happening. And that's kind of, so you look at as many things as you can to convince yourself that the change is happening. And this is one of the things that I look at for sure. And this is kind of gives you, an idea, why is it important? Because this is the same thing, but it's, Goldman Sachs put this together. So it's similar to like early stage, mid stage, late stage recession, but they call it despair, hope, growth, optimism. So we were in despair. Markets are usually down 43%. Fundamentals fall, that has happened, and then earnings per share drop. And I think we're in this phase, hope phase, which is short, but this is the best performing on a time frame basis. Right. So look at this. This is the anticipation here. Real earnings per share are still dropping, but the market's up 40% over 9 months. Fundamentals are starting to get a little bit better, but not, and then this is the growth phase, which is the longest phase. Now you have everyone, again, in this phase, things still look bad. Yeah, that's the things still look bad here, but something's changing. And again, this is where I think we are. In this phase is, growth. Everyone's on board, but there's still some people that are like, yeah, I don't know. And this is the last phase where fear of missing out. Now you have earnings are falling again, earnings per share. And, rates are around 65% during a time frame. But in here too, like this growth phase, you see PE expansions falling, and that's because now your earnings are coming in. So here's like if you're waiting to get validation to get in the market, you could be already 50% in the move already. So this is where I like see negative earnings. This is why you want to get in. You want to try to get in before that happens. But so again, we try to find things to convince us that it's happening before it happens. All right, so here's another thing. This is interesting too. I don't know if you're hearing a lot of people talking about bear markets. This is a bear market rally. So every bear markets don't go straight down. They also go up, down, up, down. You have lower highs and lower lows. But here, since 81, again, Goldman Sachs put this together, the average length of a bear rally, meaning markets going up during downtimes. 60 days is the average, but the highest since that time frame was 105 days. And then we're already at over 200 days in this rally up. So we've not since 81, there's never been a bear rally over 105 days. So again, is this something that you just look at? No. But again, we're trying to build conviction that this market's moving higher. Again, not in a straight line, but that this is not a bear market rally. Another thing too, I don't think I have on the on this screen here, but another thing that has happened, the 200 moving day average, the market crossed over the 200-day moving average, which is pretty important. And if you look at the 200-day moving average over, I don't know, like 20, 30 years, we just bounced off of it and moved back up. So again, those are signs of something's changing. Not in the news.
No, never.
Okay, so here we have is another indicator that we look at, PMI, Purchasing Managers Index. So what this basically is, determines the health of the economy. So it's your manufacturing and service kind of tracks that. So if you're under 50, see, this is 50 right here. If you're under 50, that means the economy is contracting. If you're over 50, it means it's an expansion. And then on average, you're looking at between 50, 54. So right around here is the average, if you can see. That means the economy is doing well, it's expanding. That's kind of where you want to be. But also could be a good leading indicator of a turnaround. So here we were contracting for a long time, pretty sharply. You know, what happens here, you know, supply chain issues maybe, but, you know, really interest rates going up, businesses slowing down, orders going down. And here you see it's starting to move up, right? So historically, again, this is not anything. I wish there was one thing that you could just tell you the true movements of everything, but it's not that easy. You have to look at many different things. So historically, when this hits around, you know, if it's under 40, I mean, it could go under 40. I mean, if it did, then it's like you want to be in the market because that you want to buy in. Historically, that has been like great buys, but it's been through like COVID, right? COVID hit, boom. You know, this is 2008 financial crisis. So you see, these are like times in really despair, uncertainty to the top, VIX to the top. So you don't see those a lot, but on average, like this is kind of the, you know, recessions or pullbacks where market usually turns around. So, you know, and then again, from you know, from data, and if it's between 42 and 44, that, you know, you don't want to buy because we're heading towards a pretty, you know, big, not friendly recession. So it's kind of like, you're okay to buy within, you know, 46 to 48. If you think that there's a mild downturn, provides a great buying opportunity because again, things could start picking up. But if it goes through that, that means, all right, it's falling further, and you might just wait until it goes to 40 to start entering in. And then once it shoots back up and it goes to around, you know, 58, then again, you know, you can start getting cautious. So it's not always, when I say we're always optimistic not on the risk side, but we're optimistic on the safe side too. So if we see things that, all right, now the risky things are not as great as they were. Well, let's get to the, what else is good? Well, say bonds are much better now than they were. Well, maybe get into some bonds. So again, that's always also being optimistic on future growth, but not necessarily always a risk on assets. This chart shows you liquidity of China. And again, as I mentioned before, China's ahead of the US. I mean, the Chinese market got destroyed last year.
As far as their state in the business cycle.
Yeah, well, and the markets.
Right, on their recovery.
Yeah, so on the business cycle, that's where I was talking about, where it's ahead of the US on the recovery. It's about, you know, 12 or so months ahead, based on, you know, they've already stopped increasing interest rates. I think people are expecting them to start lowering, but I think they just mentioned that they're going to just keep them where they are. But what's important here, this yellow line, well, housing prices, you can see them falling, but the blue line too, this is credit, right? So when credit falls, that means things get tight and you can't lend money, and usually, you know, business slows down, economy slow down, markets fall. So credit is very important, and it's been falling here again. You can see how it mirrors the market, and here it's starting to go up. So their credit, their liquidity started to increase, which should push their markets much higher. But right now, what's pushing them down, I think, is just the geopolitical risks, less than what their markets are doing, you know. So if you took the geopolitical risks, I think they would be up much higher. They're down like 60%. I think opportunities there over the next 5 years. You know, I say 5 years is probably quicker, but that's the way I like to look at things. The next 5 years, will this be higher than it is now? Yes. What's the probability it'll be up this much or that much? And that's kind of, you know, and then why will it be up that much? And liquidity is a big part. So I think US will probably be going down, because with all the bank issues going on, I think liquidity will be drained. So we could, again, have some challenges monthly, and then you should have liquidity shoot back up, Fed coming in, maybe reducing rates. And again, markets moving higher by year end.
Mhm.
This is also a big part of inflation right here. So this is the shipments. This is last year when we had the supply chain issues. Supply chain issues just got out of hand, and that caused inflation. That wasn't it alone, but that was a big part of it. I don't think it gets enough credit for doing that. But now you see that the supply chain is pre-COVID, almost.
This is pretty drastic too, because they're looking at standard deviations from the average.
Oh yeah,
So you can see that goes 4 standard deviations above what it normally is at.
that's true. Now it's one standard deviation under its average.
Mm-hmm.
So yeah, I mean, so again, that's deflationary in my thought. So that's a positive for inflation. Let's see here. So now let's talk about a little bit Fed. There was a Fed meeting today. I know we were discussing earlier. I hope they don't mess it up and then we have to redo our whole presentation.
Our buddy
Didn't realize
Jerome.
they're doing it today. Well, we knew, but just didn't think of it. But it worked out. I mean, 25 basis points. I don't think they should be raising, but it was expected. You know, after raising, basically 5%, what's another 25 basis points? You can think of it that way. And they were dovish, meaning they didn't say we're going to keep on hiking. So now there's a possibility of them dropping, pausing and dropping, which would be great for technology, the things that dropped last year. So the things that they're looking at. So again, Fed, what do? Max employment, price stability, also balance sheet. They use their balance sheet to increase liquidity, quantitative easing to do that as well. They can stimulate the markets by printing money, giving it to people or the banking systems. And the lender of last resorts, meaning like right now, right? You have the SVB bank and a couple other banks running out of, well, not running out of money, but they don't want to sell their investments to cover their withdrawals. Fed steps in, saves the day. So a lot of people are scared of the banking crisis, like something happening there. And it's true, it could. But the thing is, with Feds they're not helping with increasing interest rates, but they'll step in. And that's the thing. If they don't, I think the people that are worried about debt, I think it's too late to worry about debt. We're in a world of debt, and that's how we have to gauge the world. There's like 7 billion, or I forgot the number, but 70, I'm sorry. There's so much for every dollar that's created of new money of debt, $7 needs to be refinanced. So we're talking about, we're already in debt. Now what's important for liquidity to be there for this money to keep on refinancing. That's why they really don't want high interest rates, but liquidity is more important than interest rates in the world that we live in. And the Fed will be there to bail them out. And if they're not, then it's just, then it's have some water and guns.
Bigger problems. Yeah.
Yeah. But, you don't prepare for that with your money, because then it wouldn't even matter anyways. If it's that bad, because this is all paper, right? So, and the odds of that are very small. So I always say, let's focus on what's going to happen. You're going to retire. You're going to need money when you retire, based on your cash flow. This is how you should be invested, and all this other stuff that's super scary. We try to mitigate by taking care of it in a different way, not your money that's for your retirement. So what Fed looks at too is they look at, again, what drives inflation. There's many different things, but what they're focused on is jobs. So when they increase rates, they're trying to reduce inflation by people losing jobs, the worker having less power, and having the employer have more power so they can reduce wages or not increase wages to fight over employment. But this is a JOLT report, what it measures. Again, leading indicator. So the Fed says that, the job market's still not tightening, but the leading indicator would be, this is companies, hiring, right? So it's showing how
many open jobs.
Yeah, how many open jobs? Thank you. So this is showing how many open jobs, and it's been falling, as you can see, over the past year. And that's a leading indicator, meaning that there's companies are less willing to hire. And on top of that, another topic, AI coming up. I think IBM just announced they're not going to be hiring 7,800 employees over the next 5 years because of AI could just take over that. So that's another job destructive technology. Technology is deflationary. So that's why over time, I'm not concerned about inflation. It could be it's a short-term thing. And these, well, I won't get into that. But Fed's futures, this is something that, again, this morning, we looked at, there was 85% chance of them raising 25 basis points.
Yeah, this is looking at June.
Oh,
the
June
meeting. Yeah, so traders think that there's an 85% chance that they'll pause or lower at the next meeting. And this is actually old. We looked at a new one.
Oh yeah, that's right. So the new one we saw. So this is before the Fed meeting.
Yes.
There was a 85%. The June hike, 85% of a June hike. After the meeting, where's the June 80? Oh yeah, so this changed to 87%. Think they'll pause.
To pause, yes.
Right. And then July, these are futures. So these are like just basically betting markets. In July, they think that they will cut. And then in September, so it's 37% think they will cut. And by September, 25% will think they will cut 50 basis points. So again, these are things we look at, just leading economic indicators to help us see if interest rates are falling. That's a positive. This is liquidity. I won't get too much into it, but you see the liquidity falling, markets falling. So we just had an uptick in liquidity, now down. Well, some of it has to do with even JP Morgan buying out one of the banks. What was the bank? The first, and then one of the stipulations in there was that I think that FDIC covers 80%. If they lose money on the loans, the first 80% the FDIC covers. So it's really a kind of a thing for JP Morgan. But they repaid the balance sheet. They repaid the feds. So by repaying them, that reduces liquidity. Again, that's the topic that we could probably have an hour on. So I'm not going to get
sure.
But at the end of the day, what you want to know is credit creates growth. So when banks don't lend, that's negative for the market. So we may experience that for just a couple of months. It should pick back up. This chart shows you pivots. So date of last hike. So this is when the Fed stops hiking. And if we have a soft landing and the Fed pivots, the blue line, this is what the markets have done in 66, 69, 84, 85. You can see nice move up. So this is a very interesting part, soft but hard landing. Soft but ended up hard. So thinking it's a soft but ended up hard landing, still markets up higher. The worst one was if you just have a hard landing, it
went sideways.
So it went down, but really over next 20 months, 22 months, you're going back up higher.
Marty, could you kind of go into what the difference between a soft landing and a hard landing is?
Yeah. So, well, really, it just comes down to. There's so many ways to explain it. A soft landing would be employment, not too much destruction of employment, not too much destruction in credit, not too much destruction in, businesses trajectory. And a hard landing is people are losing jobs. No one's getting loans. You can't get loans because, you don't have a job. You can't pay back your debt, defaults. So kind of soft landing will be like, oh, that was a recession. Yeah, some people suffered, but it wasn't like that. It's really you lost money in the market.
The severity.
Yeah, you lost money in the market, but it wasn't anything. And then again, the economy too. A lot more people that lost their jobs that are
right.
They can't pay. Yeah, so those would be the two. Most of no, they vary. Again, I know there's too much. So inflation, let's talk about inflation. This is a big part of where the market's going to go. Everyone still thinks inflation's going up. But, we discussed this, we've been watching this for a while. So this is a chart of inflation. The red line is all of these categories that are in the inflation number. So the red line going up right here, right? So food, energy, electricity, all items less food, and what we decided to do. So everything's falling. If you look at, you can see it's already, inflation is falling. It was almost at 9 point something. Now it's at 5. So inflation is falling, but what's not falling is shelter and food away from home, which would be restaurants, things like that. So shelter. But again, the shelter in 82, they stopped the way they measure that. They don't measure it by house prices anymore. They measure it in a different way. They do surveys. But we know, just looking, I mean, everyone looks at home prices, see that they're falling. And if you look at, the Schiller Home Price Index, you see that's already fallen right here. So now everything is falling, deflationary. And that's why we think we're going to have a huge deflationary time, maybe over the next few months, is because once this is such a big, and again, I think it's like 40 to 50% of the whole index. I mean, it's a huge
component.
Component. If this starts falling, this thing's going to accelerate to the downside. And we know it should start falling. But again, the way they track it is lacking by a few months, right? So everything points inflation falling, meaning the Fed shouldn't be raising rates. But again, they're raising because of the wages, but we see jobs falling as well. And I think I did a video when it was during during COVID, and I noticed that a lot of people that were losing their jobs was the service sector, so less paying jobs. And you need a lot more of those people to lose their jobs to impact the purchasing power of the economy. But now we're seeing more of the higher end jobs being lost. So I think less of them need to be lost in order to impact the economy in a negative way. And and all this stuff you can get, this is all online. Some of it's from the government, some of it's from companies. Trueflation, they predict inflation, and they've been spot on. They're predicting inflation. I mean, they had a little, but they thought it was going to go up a little bit and then back down, but a lot of the indicators are pointing towards, under 3% inflation. So again, inflation, evidence of inflation falling is this red, and then this should follow, which should push it much more. And then again, inflation being, I think when you look at the components, it's usually like, historically 30% of the components are in negative territory and some are positive. But I mean, we could go to a level where like 60, 70% of them are falling, which will probably be something we never saw before. And meaning the Fed will probably need to reduce rates. Mortgage houses falling, projection of inflation falling. M2, this I always bring up because people think that, so if the Fed comes out and starts, printing money, they think they'll increase inflation, but it depends on what they do with that money. But M2 is your money supply and the banking systems and, the cash. So this is since 1945. The red line is, let's see, the red line and the black line. So the red line is your inflation, and then the black line would be your M2 money supply. So you see, and I think it was before, like it kind of mirrored it. And then it kind of like disconnected, like even here. So it went up, money supply, inflation went up. So it kind of did. And then like in 80s, it went up, inflation fell up. Like what happened? The biggest thing that happened in the 80s on is that, the China and the US had the trading agreement. So now you're entering the world of globalization. Now, what does that do? Well, globalization is deflationary. It brings down prices. Technology is deflationary. So now they printed money. I mean, look how much money they printed here. It was like trillions of dollars, COVID, right? Deflationary. And then here, boom. But here, the little different here too is a lot of money was printed and given to people. So that could create inflation versus being stuck in the box of banks and they're doing their thing too, right?
And the supply chain issues that you mentioned earlier.
And the supply chain issues, but you're seeing it falling again, So again, M2 is not, we look at it, but just I wanted to show you, just don't be scared if they start saying QE, because there's ways they do QE that doesn't really increase, the dollars in the market. Again, it's something that I could talk about an hour or two on.
Yeah, and just to let you know, Marty, we are about 3 minutes from 6 o'clock. If you want to cover one or a few of these slides, I know we don't have too much more to go.
Okay.
Yeah. Yeah, we are nearing the end there. I want to get these people to bed too.
Yeah, no, absolutely. I know, especially New Yorkers.
Yeah.
Perfect. So banking crisis, I think, I don't know if I need to go too much into this, but basically some banks got caught off hand. They invested in long-term bonds. People wanted money. Now bonds are down for them to, give people their money because they don't hold it at the bank. They'll invest it. They needed to sell those bonds that are down, and that's causes negative. That's what causes the loss on the banks. Now you have a run on a bank, which is the first digital run because no one ran to the bank. They just typed it on their phone, transfer money, boom, done. But that's the dangerous of living in this world. You could transfer money very quickly. But again, the Fed stepped in, helped out. Again, it's not over. Usually I like to pick up things that are down. Energy fell, we like to buy it. Banking, I think once the Fed does truly, when they talked about the pivot a little bit, and if they start reducing rates, then maybe it could be a good time. But I'm just, I think there's regulations maybe coming on, and I think there's other opportunities are better than a lot of picking in here, Gold, I'll talk about gold because I'm sure some people want to hear that. Gold, just here's a little example of performance of the stock market, blue versus gold over time. Okay, since I don't know what the date on here starts.
It goes back to 1900, I think, or
so it kind of just tells you. And again, everyone's different, but this is how I look at it. Okay, so it's not a recommendation or anything, but this is how I look at it. I've invested in gold a few times based on trying to figure it out, and it's never worked out to a way where I was happy with it. When the market falls, gold falls a little bit, but it doesn't do much. Like when I put money into it, or it's up a little bit, might as well have money in cash, or in the beginning. And that's the contradictory part of investing is with what the Fed will probably do, they will devalue the dollar. Gold does really well when you devalue the dollar, but also if you think about if we are in the early signs of early parts of the expansion business cycle and everyone's jumping on the stock market, I don't know if people will be buying gold, right? So in that first stage, gold doesn't do that well because everyone just goes into risky assets because they're trying to get in that beginning part. So yeah, gold, the way I would look at gold is devalue. If the dollar will probably be devalued over time. If you want to protect your dollar, you buy gold. But it should be something as a percentage of, I want to have this much in my bank account. I want to have this much, a little bit longer money, maybe in gold to protect my dollar. But on my, 4-year, 5, 6-year money, again, gold should do well in this environment, but I think stocks will do better, but again, protecting your money. But I think also too, cyclically gold, right now probably could have a nice rally and then maybe fall based on, cycles. It could fall into the summer. And if it's, if it had such a nice run up, it could pull back. And I think if it was me, I would enter it at that point. Just wait, and so banking's FDIC insured, gold, bonds. I don't really need to go into this. This is just the MOVE index. You see how the volatility of bonds.
Right, and how they did last year,
Yeah. So, and this is something that I'll go over to. TLT, it's a 30-year bond. And no, 20. Yeah, 20. I'm sorry. Right?
Yeah.
20. So 20. This is when the Fed started raising rates. Fed rises rates, TLT falls. October, this is the bottom of the market. The Fed, I had a little pivot here. Everyone still says inflation going up. The Fed's going to keep on raising the market. The bond market says, no, it's not. They disagree, and now it's kind of consolidating. But if you think that the Fed, is paused and eventually they're going to reduce rates, this should just follow up. So we have been picking this up. the test is 110. You see like 110. If it crosses 110, that's really a positive. But it's been in this sideways, everything, it drops down to 100, could go down to 97. I try to pick some up. But this is, again, if you think, even if there's a recession, what's the first thing that happens when there's a recession? The Fed reduces rates. Recession hits, Fed reduces rates, this skyrockets. So it could be a technical trade too, where if this skyrockets, I would sell it and then buy into the market. This is the volatility index of stock market. Very low. It's falling. It's low. It's like 15. It was over 20 all last year, which is a good sign. I think volatility being, but it could probably, it's a kind of like whenever everything goes under its mean, on average, if it averages 17, say now it's at 13, probably it's going to go back to the average. Meaning if the VIX go up, the market could have a pull down, and but again, short term, these things, that's how they move. So this is more of an entry point thing. The VIX goes up to 30, 40, everyone's fearful. We're more likely to start buying because you see through history, those are great entry points. So usually when the VIX falls means the market goes up. Here the market falls. So we look at these things as, so now it's pretty low. It probably will go up. It's meaning the market could, and again, this is on a month to month basis, as you see, it goes up and down. But so that's kind of where we are. I think the markets are fairly valued. Some things are overvalued. We could have a little bit of over the next few months, I think we could have a little bit of pressure to the downside, especially with liquidity. But I think we're approaching a new business cycle, meaning it could be a good, few years. If there's, a geopolitical risk, there's a lot of things, but based on the data. So this is just to end it up. We are at 6. What does all this mean? What this all means is inflation likely to go down, which is good for the stock market. Technology should continue to lead, not only because of inflation falling, but because of AI, which is my brain. What's AI?
Artificial.
What's up?
Artificial intelligence.
Artificial. I always think of alternative energy. I don't know. I know it's E, but every time I say AI,
like energy.
Alternative investments. So there we go. Yeah. But artificial intelligence, which will be deflationary. I think you need tons of computing power, which getting into chips, NVIDIA, and all those, which probably could pull back, shortly. But that's where the future is. TLT probably skyrocketing if rates start falling. Growth versus value. Energy has pulled back, but we still like energy. And another thing too, I didn't mention industrials. Historically, when the PMI turns around, means it was falling and it turns around. Historically, industrials do extremely well over the next 10, 12 months. So industrials could be something that we are going to overweight as well. But we wanted to keep you on time. We don't want to take it too long. So I'm just going to finish up. Thank you, everyone. Then Tyler, you can maybe finish us up.
No, I want to thank everyone as well. We're definitely going to be having more events in person and virtual. So just be on the lookout for those invitations. And again, thank you for joining us today. We really enjoyed doing this. So thanks for the support.
Perfect. Thank you, everyone.